Hey everybody, welcome to this free edition of our Trader User Weekly Roundup for the trading week ending June 3rd, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is this bullish rally over, or do we have more upside to go? Let's jump into it and just kind of see where we've been and where we could possibly go from here. So if we look at the index performance for the week, you can see everybody was in the red. Everybody's in the red year to date. Everybody's in the correction territory or bear market territory, except for the Dow. They're neither in correction territory at all. S&P's in correction. Nasdaq's in a bear market. So's the Russell, although year to date the Russell's down, not down as much, but they are from all-time highs in a bear market. I think most of the indexes gave up all of the prior week's gains. We finished down, as I said. But the economic data that's hitting the tape really didn't do that much to support worries of an impending recession. We got on this past Friday, we got the Labor Department. They showed employers added about 390,000 non-farm jobs in May, well above consensus. So that strong number put a little bit of fear into the markets that, well, with the stronger the number of the economy, then the Fed's going to have to be a little bit more aggressive to tamp down that inflation. So I think that's what set the markets down and put us into a dive going into this weekend. We also see that the ISM gauge, services sector fell a little bit more than expected. It hit its lowest level really in a year. All right, consumer confidence also fell as workers are growing a little bit less enthusiastic about the job prospects that they have out there. So all in all, mixed to slightly bearish as far as some of the economic data goes. Okay. You can also see the PE ratio is around 18. It's still higher than I'd like it to be. I'd like it to be in the mid 16s. That would suggest a little bit more lower market price for the S&P. The dividend yields at 155 10-year Treasury, just slightly under 3%. You can see the earnings yield for the S&P still up there, just south of 5%. And the S&P yield over the 10-year Treasury is still rather strong at 2%. So you're going to still see money kind of chasing yield. And I think we're still seeing that right now. The VIX, even though we finished down, as you can see, for the week across the board and with all U.S. indexes, the VIX actually came in just a little bit. So I know a lot of people on TV and a lot of gurus are saying that they want to see a VIX 40, before they see the bottom end. I don't really see that. I do see more of an orderly move lower and a reval of all stock valuations, primarily in the tech and growth sector. So it's just been an orderly move lower for the entire year, to be honest with you. That's just kind of what we're seeing. Best performer for the week was energy, up a little over 1%. Worst was healthcare, down 3%. Healthcare was the best performer the prior week, so it completely gave up everything it gained last week. Energy year to date up 62, almost 63%. Discretionary is bringing up the rear as far as S&P sectors at 25%. So all of it, all in all, is not that good, right? And as I said about the economic data, the ISM gauge fell just a little bit lower than expected. It's at the lowest level in quite some time. Okay, so that's a little bit about what we're saying there. If we come over to U.S. Treasuries, U.S. Treasury yields, it increased a pretty good deal this week. The benchmark 10 years, you can see there, moved up to close out the week at about 296. Okay, previous week was at 274, so that's a pretty big move for a week for 10-year Treasury. Okay, and of course, if we come over here and look at Europe and just kind of see how they did, all in the red again. Euro stocks, FTSE, CAC 40, DAX, all of the European markets were in the red for the week. Only one, as it's been all year long, is in the green, the FTSE. But outside of that, everybody in the European markets are in the red. Inflation across the EU zone, all the 19 countries that make up the ECB, recorded a record high of 8.1%. Really very high. Meanwhile, the EU leaders, they agreed to ban all seaborne Russian oil deliveries, covering about 2/3 of their imports. They're looking at doing that fairly soon. Meanwhile, Gazprom, which is a Russian state-owned energy company, cut off Netherlands. So that's the fourth country that Russia's cut off that refuses to pay in rubles. And good for them. I wouldn't pay in rubles either. But anyway, that's what's going on over in Europe. And we're also seeing that a lot of the policymakers in the ECB, they're going to have to start raising the rates. They can't keep running it where they're running right now. They really got to start tightening. And there's a division right now on just how fast they tighten. But the current ECB rate is just 50 basis points. And it's really been negative, or it's a minus rather, 50 basis points. It's been negative since 2014. So that just shows you how behind the curve they are. Inflation at 8.1%, their deposit rate, their key interest rate's a negative 50 basis points. So they're going to have to start jacking it up pretty quick. So we'll see how that kicks in and just how that kind of plays itself out. All right. Now, if we come over here and look at the Asian markets, short-term inflation in Japan's increased a little bit, but they'd like to see it come up even more. Japan's one of the few countries that wants to raise inflation. They like to see it higher, not lower. Okay. And their PMI data shows a moderate rise in their private sector activity, led by growth mostly in larger sectors there. You can see in the Japan, China, and Hang Seng in the Asian markets, everybody's in the green for the week. Although year to date, only the Nikkei, Japan, is just barely below water. Okay. China, meanwhile, I think the reason why they're in the green, and we should see a nice little run in China for about a month or two, unless they screw it up, is their government is unlocking the country. They're freeing up this tight zero COVID policy. Also, in addition to that, they unveiled more details of their stimulus programs, right? So, unlike every major country, China and Japan are really the only two where the central banks are putting money into the economy instead of taking money out. Okay. So, like I said, China's government unveiled more details of a stimulus program. And they included, I think, like over 30 measures to cover fiscal, financial, investment, industrial policies, things like that. And that's causing their markets to move up because they're pumping money into the economy. Meanwhile, China, coming out of their zero COVID, there's no surprise, their factory activity shrank a lot in the month of May. Their PMI rose stronger than expected, but it came in at 48.1. That's still below 50. Anything below 50 is contraction, above 50 is expansion. It was 46 in April, 48 in May, so it's moving up a little bit. But it hit its lowest level in 26 months last month just because of their shutdown policies. Okay. They're really not going that strong over there. And all of the markets are just very, they're in a very confused state now. Every bullish run has been met by sellers pushing markets back lower. I'm going to take you over to the charts right now. Let me just switch the screen here. Let me just move this over like this. Here we go, like that. I'm going to get you guys into this thing and just kind of show you where everything can end up as we move forward. It's going to take a second or two to get on the screen there. So now that you see everything on the screen, I've used this chart for a number of weeks, all through the month of May. You can see this Andrews pitchfork, where very few people use, but it's a really good tool when you back out. This is a weekly chart. When you back out, just to get the general trend, right? So, like I said last Sunday, we're in a secular bull market, but we could be in a cyclical bear market as we're moving down. Although officially in the S&P, we're not there. We're only down a little over 13%. But we're still showing signs of weakness. Now you can see I've got thick bars on here that extend out here, and I've got thinner bars. The thinner bars are fib retracements. The thicker bars are extensions off key pivot points. And what you can see here is we're in this area of congruency where we've got both the extension and retracements kind of lined up right here. So there's a lot of hardcore overhead resistance right now. I mean hardcore. I told our members that anywhere from 42 to 4,300 is pretty much where I see the max upside um, before we start rolling over in later June and then July. Now, that's what the markets are saying right now. They could change if we take out key pivots, but that's what I'm looking at right now. Okay. And you can see this area here of congruency where we're just running into trouble. Some people believe that this low here was the low for the year. I'm not there yet. I'm not sold on that yet. I got to see how things shape up in June and July because that's where I'm calling for a pretty good little downdraft. Now, keep in mind, many of you probably heard the term sell in May and go away. Well, the last 2 summers, we've had very bullish summers. Coming off COVID, markets were just screaming higher. Same with last summer, too, in 21. So this summer, I think it's going to be a little bit different. We're going to introduce a lot more volatility, and I do think the odds favor more downside action. We'll see how that plays itself out, but that's what I'm looking at. Now, keep in mind, we can come all the way down to this blue line, which is the center of the Andrews pitchfork, up, and still have a secular bull market in my mind. Now, notice all of these prior runs higher, right? I mean, if we look at this, and I've shown this to our members, I'll show this to you guys as well. If we look at it, you can see that move right there covered from the bottom to the top, right about there. It covered about 11.45%, 476-point move, and then we rolled over again. That shows you these bear market rallies or counter-cyclical rallies, if we're not really in a bear market, how they can fool you. So if I were to put that rally right over where we are right now, you can see this takes us all the way up to 4,300. All right, and still be like this rally right here from a symmetrical perspective and still roll over. So you've got to be very careful. All right, now that's why I use 4,300 as the upside of where we could go, but I give it, it's got to get through this area here, which is very tough. Okay, so that's a big rally. And if we look at this other rally here, that happened. Let me just move it over here and let's look at this rally right here. It doesn't look like much, right? But it moved up right at about, let's see here, right about there. It moved up 381 points, a little over 9%. Okay. And if I put that rally on where we are right now, off of these lows, right like that, it would say we still have more upside to go around 4,200 before we roll over. So rallies being symmetrical, counter-cyclical rallies are very similar in a bear market or a bear market chart. So you can see that's another reason, and it takes that rally right up to about 4209, 4210, somewhere there. So I'm looking at nothing but huge overhead resistance for the next 100, 150 points. And then if we can get through it and then find that as support, then I'll give kind of a coast is clear, the low has been made. Right now, I don't believe that. I believe we're still in a counter cyclical, so you got to just be very careful in how this stuff is moving around. Now I'm going to show you another chart here. This is the S&P 500 E-mini futures. You can see also, in addition to those overhead resistance I'm showing you, look at the 50 EMA right here. It is sitting on these bars. We've been sitting here under the 50 EMA fairly close, sometimes moving over intraday and moving back below like we did on Friday or like we did on the 31st of May. But we can't clear it. You can see that fib node right there. It's a shorter term fib node, but it's sitting at 23% pullback. So this is a lot of overhead resistance. When you put all of this together, the 50 EMA, the fib extension, the fib retracement, as well as the similarity between other counter-cyclical moves in this overall down-moving market, shows you just how tough it is up here. Now, that doesn't mean we can't climb through it, but the odds favor we're not, okay? And if we do climb up into it, the odds still favor to roll over. The only way I'm going to reduce those odds, and this is a daily chart versus the weekly I showed you before, you can see the 50 EMA below the 200 They're starting to span out a little bit more, which shows we're due for a rally. That's what we're getting right now. And generally, the first point of failure in a cyclical, counter-cyclical rally in a bear market is hitting the 50 EMA, because the 50 EMA in a bear market is almost always below the 200. If we clear it, we still got to clear the 200, which is sitting up just north of 4,300. All right. I don't know if we're going to be able to do that now. I don't see the energy for this. In fact, on my Elliott wave count, it's suggesting that we can go even lower. And I've shown you these bars before, but if we look at the Elliott wave count, it is suggesting, and it doesn't have enough data to completely finalize this thing, that we can come down to about 3729, right? All the way down to 3,500. It's suggesting even uglier than what I'm suggesting. My general support area is between 37 and 3,800. So, and we came down and hit my original target of 3,800. Actually, we hit 3,807, as you can see right here, which was very close. I mean, we almost came right down to a T and hit that 38% fib retracement. All right. So we've got a lot of support down here, but it's still a lot further the way down than the 4,300 is up. So that would suggest to me that the bigger risk right now is to the downside. Okay. So that's kind of the way we should be playing it for our members, and what I'm running here, especially for our portfolio margin folks. We're making money this year. We're doing well in the strategies that we're deploying, but you just have to be careful in these markets. And of course, if we look at the Dow, which is the best performer on a daily chart, you can see the Dow was never lower than 16.9%. And you can see here with the Dow, on Thursday, we got above the 50, and on Friday, we closed below the 50. You can see 1, 2, 3, 4, 5. Each day, we closed above the 50, below the 50, below the 50, then above, and then below again. So we're doing that rain dance around the 50 EMA on the Dow as well. So just like the S&P, I want to see us get it, hold it, and challenge the 200. That'll be step 2. But if we can't get beyond step 1, then we're still going to have downward pressure on the markets. Okay. Now, if we look at Nasdaq had a really ugly day on Friday. Okay. You can see Nasdaq for the year, or it hit a low for the year on May 20th. All of the indexes hit their lows on May 20th. It was an ugly day, but it's down 31.47%. You can see Nasdaq hadn't even gotten close to the 50 EMA yet. This one needs to recover too. Now, if I move things around, I'm going to show you the Fang Index. I know some gurus are saying now's the time to get into the Fangs. You can see the Fang actually hit a low, and it wasn't on May 6th. It was a low on May 24th, right? So let me just adjust that here. Let me just edit this thing. Low on the May 24th, right? So that was the new low for the Fang, and just barely, maybe a tenth of a percentage point, 4 or 5 basis points, but it hit a low of down about 36.45. We're trying to get up above my original target point for this Fang index, because I created an index of the Fang stocks, or basically Microsoft, Facebook, Apple, Netflix, Google, Amazon. Okay. And this is kind of what we're looking at. So it is a lot uglier than the other stocks that are sitting out there. Okay. And of course, if we come down here and look at volatility, and look at the VIX right on here like this, it finished barely up on Saturday. It was only up 7 cents, right, for a hard down day. So that tells me the markets are just not that concerned right now. They're not. Let me just move this out a little bit so we can get it like this. So markets are, we're still down, right? And we're still down in some fast markets, because that's what it seems to be. But we're not up in this area up here, right? We're in this 20 to 30 range. So it's a different kind of market. And it's just been slowly going down along with the indexes, right? The indexes have been going down. This is since May 19th, but there's not a lot of volatility in the markets right now. It's just not, right? So, and then we got the black swan event up here like that, which we're nowhere near. Okay. I don't see that happening this year, but then again, black swans are unforecastable, unknowable if it's true definition of a black swan. What could happen that could cause a black swan? We have an escalation of the war in Russia and Ukraine involving a NATO country or the US. That would create problems. Same thing in the Asian Pacific area with China and Taiwan and the US, right? If we look at treasuries, we look at the bond market, down slightly on Friday, but you can see here it's going to have a hard time holding a bid. If I were to put the just an estimate here of where it could go, is right down here around 133. So I think we got more downside on this. Now, we were trading bonds to the downside in Q4 of last year, or interest rates to the upside. It's been a great trade for our members. Made really good money on that trade. It's a no-brainer kind of trade. Okay. And you can see interest rates on the 10-year move back up. All right, we came down and kissed the 50 EMA, moving back up. If I were to target it, just like I did with the bond market, because it's just the opposite, it's saying interest rates can move up to a whopping 3.31. We get up there, folks, and I promise you we'll get our 3,700 in the S&P. All right, and it's projecting that time-wise out towards the end of June into July timeframe. All right. Now remember, we got the Feds coming up, not this coming Wednesday, but the next Wednesday. They're going to hike the rates 50 basis points, but it's what they say at the press conference and how they say it is what's going to drive the markets. The markets already have priced in a 50 basis point rate hike. But one of the Feds came out last week and basically said, we may look at another 50 basis point rate hike after July. So they've got 50 basis point in June, July, and then the next meeting out in August timeframe. So you're talking about a lot of very aggressive rate hiking. That is going to undermine any kind of semblance of a rally in the markets and push it lower if that is a signal that they want to send. Doesn't mean they're going to do it, but they could send that signal just to push the markets lower. I think the Feds would like to see the markets at least another 5% lower. I think that's what they would like to see. So they may try and talk the markets down a little bit more. They're good at doing that. If we look at the dollar, well, the dollar is a safe haven right now, right? Like the interest rate, it came down, kissed the 50 EMA, and now it's kind of hovering here. I do believe longer term, the dollar will move lower. Near term, I think the dollar is going to be chopped between where we are and up here at this high price right here. Okay. Europe has got to return back to a little bit more normal before the dollar really starts cratering and going to the downside. Okay. And then, of course, if we come down here and look at gold, as I've told our members, we only have one way of trading gold, and it's a very successful way of doing it. But you can see gold is just fighting. It's choppy. It is very choppy. It hit a low down here. When did it hit that low? I think it hit the low right back over here on May 16th. No, it didn't. It hit it early in the year. It hit it actually on the 28th, but we came down and tested that low again right here. We're still in the green for the year, but just barely. All right. And same thing with silver. I would stay away from them right now. I just don't see these guys going up a lot with rising interest rates, with inflation having already peaked is kind of what I see. Oil, I think oil can go higher. All right. Now we've got a way of trading oil just like gold that would be very profitable in this market. In fact, it is profitable in this market for our members that like trading oil in the energy markets. It's just going to ride higher. I think it's going to challenge the 2022 highs. Probably even more aggressive is nat gas. Excuse me. I think nat gas can be even more aggressive to the upside. You can see a series of crosses in MACD, which would suggest bearish divergence, but any move lower is bought and buyers are stepping in. I think nat gas is going to stay high the remainder of this year. Is kind of what I'm looking at right now for nat gas. All right, everybody, that's just a quick summary of where we are on some of the major asset classes and sectors. Members, I will see you this Sunday evening for a little bit more in-depth look at this as well as some other stocks and assets. All right, everybody, have a really great weekend. For those of you in southern Florida, just make sure you wear your galoshes and take your umbrella when you go outside. We got a tropical storm blowing through the area. Have a great weekend, everybody.